Here we stand today, the S&P off more than 20% year to date, NASDAQ down more than 30% year to date. When you try to gauge that downside risk here for equities, what does that look like?
So again, the famous adage, don't fight the Fed.
Yeah.
You know, it's been true for this cycle. It was true for last cycle when we had a zero interest rate policy. You wanted to own risky assets. When you've got the Fed increasing interest rates and the alternative, the risk-free rate, the rate of return at now sort of 4% for short duration treasury bills, that's an attractive rate of return for short-term treasury bills. And really what's happening more than anything is the equity market is trying to figure out what are the future earnings of a company. So remember, the value of a stock is the present value of future earnings. So if a company has higher input costs and it has higher labor costs, and hopefully if the Fed is successful, lower demand for their goods or services, what does the forward earnings of a company look like? Then I could put a multiple on that. And right now, the market is trying to determine what forward earnings are going to look like and what multiple that should trade at. And as long as the Fed is continuously raising rates, trying to slow down the economy, trying to make things more expensive, trying to make labor more expensive, the market is going to continue to try and find a clearing price for that. It's like everything else in this world. We won't know we met that clearing price till long after the bottom is here. We may have met it already. A lot of people think we have not got to that clearing price. But the market right now is trying to figure out what future earnings look like and what multiple we should put on that.
Gary, I'm curious to get your perspective on this. The job that Fed Chair Jay Powell has done so far, are you satisfied with that?
I think they were late to the game. I don't like to criticize the Fed. I don't think any of us like to criticize the Fed, but they've got a tough job. But they've got an enormous amount of resources at their disposal. They stuck to this transitory inflationary argument way past where I think many of us, myself included, I'll make this personal, way past where I thought it was transitory. Maybe in the beginning, as we're bringing production back online, we're bringing supply chains back to normalized level, there was some transitory natures to it, but the Fed stuck to their transitory argument way deeper into the cycle, and it was clearly not transitory. We clearly had real inflation in the system. We had shortages, we had food shortages, we had energy shortage, we had a tough time getting people back into the labor market. So as I said, the Fed was late, and when you're late, you're playing catch up, and I think they continue to play catch up.